My name is Jennifer Parrish, and I am going to do a review on insurance policy recommendations for Mr. and Mrs. Smith. The first topic that I'm going to discuss is health insurance. Currently, Mr. and Mrs. Smith have a high deductible health insurance. It's $3,000 family deductible, 80/20 major medical insurance, and the total out-of-pocket cost is $6,850. That's including deductibles. The plan that is optional to them outside of the high deductible is the traditional. This particular plan also has a family deductible of $3,000, 20% family co-insurance, $7,000 out of pocket, including the deductibles. One of the differences is the retail prescriptions is $60 or less, the mail order prescriptions $120 or less, and urgent care is $50 copay, and then the insurance pays 100%. My recommendation is for the Smiths to continue with their high deductible insurance. With Mr. and Mrs. Smith having routine checkups for them and their families, having just the one deductible is better than the copays. Also, with a $75,000 and a $25,000 procedure coming up, the household will basically have to contribute less than 10%, which will save them money in the long run. Recommendation um, is for the long-term insurance that the family has. Currently, both Mr. and Mrs. Smith have their own occupation long-term disability insurance, which their employer pays. They pay 60% gross. The elimination period is 90 days. It covers sickness and accidental illness. The other disability is any occupation and split definition. Any occupation is basically if you can't do your job, you have to, if you can do another occupation, you can't, even though you're disabled. The split is basically both. You have the own occupation for at least 2 years, and then you go to any occupation. At this moment, I think you all are actually in the correct plan for your circumstances, and your employer pays into that plan. The only downside is, yes, you have to pay taxes because you don't pay the premium. Long-term care. At this time, you all don't have it. I do not recommend it. Um, it's not needed until you get roughly 65, but I say revisit around 63 to start talking about it so you can start looking at some things to include that in your insurance package. Homeowner insurance. Currently, you all have that HO5 homeowner insurance. Your premium is $2,600. You have a base of $250 insured on your home, and your home is worth $375,000. There are some tweaks of recommendation for the homeowner insurance is to increase your home insurance from $250,000 to $340,000. Currently, you all have a mortgage of $337,000 roughly on your home. If something was to tragically happen and your home has to be rebuilt from the ground up, the insurance that you have does not cover your total cost of your home value and what you owe the mortgage company. Coverage B is basically the outside dwelling, garage, maybe any outside attachment that is on your property for your home, and it's usually basically 10%. So I increased that from 25,000 to 34,000. I would say decreased coverage C from 175,000 to 170,000. This particular coverage, if your house has to be rebuilt and you can't say stay in the house, that amount of money kind of gives you uh, a place where you can rent temporarily 6 months, a week, however you need to, for an extended period of time to still make your family comfortable. Um, the increase in coverage D is to cover your personal property. You have 50,000. I would say increase it to 102,000, which is roughly um, about 25% of the total amount of your house's worth. The increase and decreases that I suggest basically transfer the risk from you as homeowner to the third party, which will be the insurance company. Now we're going to talk about your auto insurance, the type that you have. Your bodily injury, you have 50,000 to 100,000. Property damage, 10,000. Medical payments, 5,000 per person. Physical damage is the actual cash value. Uninsured motorist, 25,000 to 50,000. Your comprehensive deductible is 200. Your collision deductible is 500, and your annual premium is $2,600. Which I do believe that your auto insurance that you have is efficient to the slightly below minimum uh, requirements for the state of Kentucky. On my next slide, I actually introduced some recommendations for you to be at the minimum and above what you need, and also reduce your premium as well. Recommend for you is a little bit base but above the minimum coverage for the state of Kentucky. Here I have listed the minimum: 25,000 bodily injury per person per accident, 50,000 bodily injury for all persons per accident, 10,000 property damage liability, and 10,000 insurance injury protection. Um, the decrease in bodily injury, I felt the 25,000 and 50,000 would still remove you from the risks, but also get you ahead where you need to be. The increase in medical needs to go up to 10,000 per the minimum for the state. And increasing your comprehensive deductible will also bring down your premium. Personal liability insurance, right now, you all don't have any coverage, but it is very important that you do insert coverage into your policy. This covers your entire family, the insured and residents, to any damage that is caused by a resident for anyone on the premises. My recommendation is at least $200,000 personal liability coverage. If something was to happen on your property, this covers the legal defense costs, settlement costs, damages to the injured. Example, you can have a party at your house, a child gets hurt, uh, their parents have to take them to the emergency room, and they may sue you. This covers that portion to where you're not coming out of pocket. The other recommendations I have is continue to ask questions. Be open with your advisor. Um, Seeing a financial advisor is not always easy, but as you build the relationship, um, know that that advisor is there to help remove the risk from your family, and make it easier on you all. For my conclusion, I have my references here. Um, Thank you for your time and have a great day.